Just like that sudden stop, the market can turn against you in an instant. What if you could identify the signs before the market moves against you? That's where the power of RSI and Fibonacci comes in. This strategy works for both beginners and experienced traders, and by the end of this video, you'll see why. So let's dive in. Required tools. To execute this strategy, we only need two. 1. Fibonacci retracement, to determine key support and resistance levels. 2. RSI, relative strength index, to confirm entry and exit points. What is Fibonacci? The Fibonacci sequence is a series of numbers where each number, after the first two, is the sum of the two preceding ones. 1, 1, 2, 3, 5, 8, 13, 21, 34, and so on. One fascinating property of this sequence is the ratio between consecutive numbers. As we go further in the sequence, if we divide each number by its preceding number, we get 2 divided by 1 is equal to 2. 3 divided by 2 is equal to 1.5. 5 divided by 3 is equal to 1.666. 8 divided by 5 is equal to 1.6. As this pattern continues, the ratio approaches 1.618, a special mathematical constant known as the golden ratio. This ratio appears everywhere in nature, from the spirals of seashells to the arrangement of sunflower seeds. Interestingly, it also plays a significant role in financial markets, helping traders analyze price movements and predict possible turning points. What is Fibonacci retracement? Before we dive into applying Fibonacci retracement in trading, let's first understand what it is. Fibonacci retracement is a technical analysis tool based on the Fibonacci sequence. It helps traders identify key price levels where a trend might reverse or continue. When a market moves in a strong direction, up or down, it rarely moves in a straight line. Instead, it tends to pull back, retracement, before continuing in the original direction. Fibonacci retracement levels help traders identify potential areas where these pullbacks might end and the trend might resume. The most commonly used Fibonacci levels are 38.2%, 50%, and 61.8%, which act as support in an uptrend and resistance in a downtrend. How to use Fibonacci retracement in trading? 1. Identify the trend. First, find a clear downtrend or uptrend on your chart. 2. Draw the Fibonacci levels. Select the most recent swing high and swing low, then draw the Fibonacci retracement tool. The 38.2%, 50%, and 61.8% retracement levels are the most important. These act as strong support in an uptrend and resistance in a downtrend, meaning price is more likely to react at these levels. As you can see in this chart, the price retracement has ended at the 50% level and then continued its main uptrend. By combining these Fibonacci levels with RSI, we can increase the accuracy of our trade entries and exits. How to use RSI? RSI above 70, look for a selling opportunity. RSI below 30, look for a buying opportunity. If RSI is between 30 and 70, avoid trading. How to enter a trade? Entering a sell trade. Start by identifying a significant prior uptrend, where the price has made higher highs and higher lows. This uptrend will serve as the basis for drawing Fibonacci retracement levels by selecting the swing low, the start of the uptrend, and the swing high, the end of the uptrend. The key Fibonacci levels to monitor are 38.2%, 50%, and 61.8%. Next, wait for the price to pull back to one of these Fibonacci levels. If the price struggles to break above these levels, it may indicate a potential reversal. To confirm the sell signal, check if the RSI exits the overbought zone, drops below 70. If the RSI was above 70 and starts crossing down through 70, a signal is generated. Entering a buy trade. Start by identifying a significant prior downtrend, where the price has made lower lows and lower highs. This downtrend will serve as the basis for drawing Fibonacci retracement levels by selecting the swing high, the start of the downtrend, and the swing low, the end of the downtrend. The key Fibonacci levels to monitor are 38.2%, 50%, and 61.8%. Next, wait for the price to pull back to one of these Fibonacci levels. If the price struggles to break below these levels, it may indicate a potential reversal. To confirm the buy signal, check if the RSI exits the oversold zone, rises above 30. If the RSI was below 30 and starts crossing up through 30, a signal is generated. Real market examples. This is a Bitcoin chart. The price has been in an uptrend from point A to point B. To identify key retracement levels, we apply a Fibonacci retracement to this uptrend. The price has paused at the 38.2% retracement level, showing no strong upward or downward movement. Meanwhile, the RSI has exited the overbought zone and dropped below 70, confirming a sell signal. As a result, we see the price declining afterward. Another example. This is a Bitcoin chart. The price has been in a downtrend from point A to point B. We apply a Fibonacci retracement to identify key levels. The price has paused at the 38.2% retracement level, showing little movement either up or down. Meanwhile, the RSI has moved out of the oversold zone and crossed above the 30 level, confirming a buy signal. As we can see, the price then starts to rise. That's it for this strategy. Remember, no strategy is perfect, so always use proper risk management and test it on a demo account before trading live. If you found this video helpful, don't forget to like, subscribe, and leave a comment below. Let me know your thoughts or if you have any questions. See you in the next one.